All right. Hey, everyone, and welcome to the Australian CFO Summit. I'll just give us a few more seconds just to let everyone join in on the session today. All right, hopefully that's given everyone the chance to join. And again, welcome to the Australian CFO Summit. You're dialed in for today's session, Financial Modeling, Hope for the Best, Plan for the Worst. Now, I'm really excited to be hosting today's session, but before we jump into it, I just want to cover a few housekeeping things. First of all, both the chat and the Q&A sessions are enabled. If you guys do have any questions throughout, please feel welcome to pop those into the Q&A feature at the top of your Zoom screen. We will be saving around 5 to 10 minutes at the end, just to go over the most frequently asked questions. For any questions we don't get to as well, David and I will be posting our direct contact details if you want to reach out directly. I also want to thank our sponsors for today's session. So you can see them on the screen here, but CANZ, CFO Magazine, DivvyPay, Huddle, ChargeBee, and of course, Fathom. Thank you all for your support today. As a quick introduction of myself, my name is Jess Miller, and I'm a customer engagement manager at Fathom, which is a financial reporting and forecasting tool. I'm here with David, who's the director of Right Brain Insights. I'm really excited to be here with David today because Fathom's really for all the courageous people behind every business. I'm keen to elevate David's work, and I just want to say, David, thank you so much for taking the time out to share your insights and stories. David, can we start by telling us a bit about yourself?
Yeah, sure. So as Jess said, my name's David. I'm the director of Right Brain Insights. Right Brain Insights is it's a consultancy, and it provides a outsourced CFO service to independently owned trade service, industrial and manufacturing businesses.
Amazing. And I know, David, that financial modeling or three-way forecast modeling is something that's really key that you support your clients with. Can you actually tell us what a forecast tells business owners and why it's so important?
Yeah, for sure. So at RBI, we deploy a three-way forecast with every business that we're working with, and it serves two purposes primarily. The first, you could argue, is a navigational tool. Yeah. So being able to see the past, the present, and the future, where you have been, where you're at now, and where you could be in the future, depending on different variables and such. The secondary thing that it provides is, I would call it a leadership enabler. It allows particularly the business owner, but also CFOs, financial managers, even other department heads, unit heads of a business, to give them some clarity, some confidence, a bit of conviction to around their decisions and where they're looking to go and how they communicate that vision, both up the chain and down the chain inside the company. So you can really bring people together too.
That's amazing. And David, in your time as a virtual CFO, roughly how many forecasts have you created?
Hundreds. Yeah, across many different industries.
I mean, that's incredible. It's a huge number. And I know when you're creating those forecasts, you use what I'd really call a leading tech stack. And I have just a few of the many tools you use up on the screen. But David, why is it so important to have reliable tech and reliable data?
Yeah, so whenever we're working with a client, we want to understand what data they have. Always we will be connecting to the financial software. That's usually Xero, sometimes MYOB. We will usually, connect in Fathom to that. But also there'll be the odd spreadsheet, things like that. But really what we're looking for is, like, some of the systems I've got there on the screen, they're just a couple of them. But we want to see where data is being captured inside an organization, because that data can be really interesting validation tools. Perhaps you can see a conversion rate or a margin or some sort of pipeline that can validate the assumptions that you're making inside the forecast, so that your view into the future is more robust. You take something like Arrowflow there, for instance, you might be able to say, well, here's a whole heap of quotes that a customer has sent out, and historically their conversion rate is 3-to-1. Okay, cool. Well, if we know the starting time of those quotes and the duration of those jobs, we can extrapolate with a fair degree of certainty what future revenues could be. And yeah, it's those kind of things we're looking for.
Yeah, I can definitely see why having an accurate and I guess true data source can really help solve that problem for creating a robust forecast. I know you've also mentioned there's a few common problems or common pain points that CFOs encounter when they're generating a forecast. Can you tell us a bit about those?
Yeah, for sure. So a forecast, I suppose from the top, like it's a difficult thing to produce. But the first thing I'd say is like the underlying financial records and some of that critical information, like what I was just mentioning. A forecast is going to start off a base of history. So like something we will do with our clients is we will interrogate their financial software before we start forecasting and say, okay, well, let's audit it, let's go through it. And we're looking for icebergs out there. Maybe there's accidental things like there's assets in the wrong category, or there's something's unpaid to the ATO or something like that, things in the wrong category. So we want to be able to look at that and understand, okay, yeah, where are we starting from, and extrapolating that into the future. If you don't do that, whatever you do forecast into the future is going to carry forward those discrepancies. And that can be dangerous depending where you're coming from, particularly if you're starting at a position of weakness or trying to survive. But some of the other issues in the forecasting exercise can be, a classic one I will say to clients in the team is, whatever forecast you're producing, it is going to be wrong. You do not have the ability to get it to the cent accurate, but you can look at particular trends and what are those stories. Now, there's almost a dichotomy there where you don't want to get too lost in the detail either, but you also need to understand the detail and where it's coming from. So sort of trying to put those two together. And the other thing I would mention is about having that goal, that aim in mind. What are we trying to get done here in this company? Are we trying to manage our growth? We're growing really quickly and we want to try and manage our bank balance so that we don't grow ourselves out of business. Or have we been hit by something like when COVID hit and these businesses are looking at a rapid violent change in their demand and now need to look at, hey, what do they need to do in order to survive? So having that goal in mind gives the forecast or the person doing the forecast a great framework to work with, because you could forecast into an almost infinite series of possibilities. So you need a goal helps you limit that.
Some direction. And I love that solution you've mentioned as well, which is storytelling. I don't think people often think of a forecast as something to tell a story with, but can you give us more insight in how you use the numbers to convey that story?
Yeah, for sure. So we'll go through that in a couple of examples that really delve into that story. But I guess in summary, like some of the ways we'll get around it is, the first thing will be talking to people inside the company. It depends on the environment, how it's all set up, what you're trying to get done. But a classic one we'll see is we will go and talk to, for instance, sales reps or guys who are doing the quoting. And off the back of that, we can understand from them sort of the top limits. Hey, this is where revenue has been, or this is where they're maybe able to take it. Okay, great. From there, you can understand a limit. In order to forecast above that now becomes dangerous. So it's like, okay. Or you may have a machine inside the business that has certain production capacities. Okay, you want to understand perhaps from the people on the factory floor what those production capacities are. And then there's another limit to build into your forecast. So, okay, if you hit that capacity, well, you better bring on another machine. And what does that mean? And so on and so forth. So there's actually engaging the people. Engaging them in the forecasting exercise also helps something I mentioned earlier about the forecast becoming a leadership tool. So if these people are are engaged in the design of their forecast. And I kind of say forecast and budget and target almost interchangeably. I know Fathom has different definitions, but I use them almost interchangeably. But if these people on the factory floor, if the guys at the coalface of the sales process are engaged in the forecast, they can understand that broader story of the broader story and broader intent of what's trying to be done in the business. So that can really help. Definitely fixing your financial records if there's things in there that don't seem quite right. Getting to the bottom of that. I'd also say, like, within the story, planning for error. Like, you are going to be wrong. Hopefully, you get the trends right, but not the exact result. That's okay. But again, it's all relative to what you're trying to get done. Particularly from a survival setting, it might be like a classic survival thing is you may need your bank account to be above a certain level, and that means survival. So okay, we've got to be there. Knowing where you want to end up. It might be, for instance, surviving for a period of time, but that's not the be all and end all. You're not in business to just survive. It's like, okay, well, trying to get out of this phase and then swapping gear into another, which leads into what the story is.
I love that.
Understanding that.
Yeah. I really enjoy
that picture.
Yeah, it does. It paints a picture, and it sounds like it pulls the team together too.
Yeah. Another thing we will talk to owners in particular about is like, why are you in business? What are you looking to get out of it? How much would you like to be able to take out of the business? Tell me about the lifestyle you want to be able to live. What house would you like to live in? Car you'd like to drive? School you'd like to put the kids in? All these sorts of things. If you understand that, this is simplistic, but that can help someone understand, okay, well, hey, there's a lifestyle aim, and to achieve that lifestyle aim, X dollars needs to be taken out of the business every month, every quarter. Okay, well, if that's the objective, now how do the financials need to stack up in order to make that achievable and safe?
I love that. Yeah, understanding that end goal. And David, you've also told me a really fascinating story about a client of yours that was likely facing financial ruin. Can you set the scene for us and tell us what their troubles were?
Yeah, for sure. So this was an interesting one. Pretty large business, about 60 people in the business, and they got hit by COVID, and basically, like everyone, they got hit by COVID, and basically their strategy to survive was not paying the taxes. It was almost an accident. It wasn't even a strategy. It was just what they had to do. And during that COVID time, the ATO was very flexible. They didn't chase at all. So, however, that level of debt grew and grew and grew, and for them, running wasn't an option. They needed to be able to pay it back. They came to their accountant, and the accountant reached out to myself and RBI. And working with them, we needed to dive into, okay, well, hang on, what got you into this situation? You are growing. Yes, COVID hit, but you actually have grown. And what is happening internally to allow that debt to rise? And also, how do we get that debt under control? Because particularly someone like the ATO can become very aggressive, and they have enormous powers.
Yes.
So that's an exposure that needs to be managed, and eventually it will come knocking. Needed to get that under control.
Yeah, absolutely. And what's the first step that you personally would take towards a solution in this case?
Yeah, so in this case, there was a few things. It started with almost simultaneously. The first thing was, well, we were using Fathom as the tool to do this, but first off, for them, it was understanding, hey, through their history over that COVID period, what allowed the debt to happen? Well, you've got a history of paying your taxes, so it's not like you're trying to avoid it. Okay, fine. So what happened? Well, we could see in Fathom through the history that there was this massive divergence between their profitability and their cash flow.
Yeah.
And it wasn't a margin situation. They were making plenty. Their profit was decent, down, but decent. However, there was a bleed from their receivables. So we could see, okay, hey, this is what we need to get under control straight away, and there's some tactics that we can do that we could execute to get that under control. That's an immediate thing to gain control of the situation, to go from, they needed to, as quick as possible, become self-funding. Because the only reason they were in business was the ATO allowed them to be.
Right.
So we needed to fix that, make sure the company could fund their own operations. The next thing, and linked in with that, was building out the forecast.
Yeah.
Saying, okay, right, now what do we do about this tax debt? How do we pay it back? They had the ability, and we were engaged with a finance provider to come in and potentially swap out the tax debt for a broader loan that would potentially give the business a bit more flexibility. And we worked with the bank in that case to build in their requirements into the forecasting and build some confidence in the bank, because banks generally don't like to finance ATO debt. It's a bit of a no-no. But to give them that confidence, we produced the forecast to say, okay, well, what matters to you, bank? There were a few different numbers and ratios we were going through, got them there. But we could build them into the forecast and show them over several months how, yep, we've set this forecast and look, we have actually exceeded it.
Yeah.
We have done better on all fronts. This business is moving forward, and this is what we're executing, and this is what's going on, which allowed them to get the confidence back.
And David, can you tell us why you call these metrics canaries in a coal mine?
Yeah, for sure. So a bit like that canary in the coal mine in times gone by, it's a leading indicator for something very bad to happen. If the canary was measuring oxygen levels in the mine, and it would go before you would. Yeah. So that was your cue to get out, and that's what we're looking for in a situation like this, is these forward indicators, these measures of progress. This is where we need to get better, or these are minimums that we need to achieve. In this case, from an EBITDA perspective, that relates to the debt rates. So that was in the eyes of the bank. Hey, we need to show consistent and more than adequate serviceability. Bang, that's locked away. Cool. The gross profit margin needs to be stabilizing. If anything, it should be able to be improved as COVID conditions come off. But also controlling that for rising material costs through supply chain interruptions off the back of COVID and increasing inflation now. And at the end of the day, increasing the cash flow, right, from the operating the net cash flow, to make sure that the business was indeed self-sustaining and safe. And if we were able to pull all that off, you would naturally see a rise in the current and quick ratios up to a level that is coming from an extremely stressed position up to somewhere that is much more sustainable and safe. And that they measured the overall financial health of the business and its recovery. So we could see that we had a trajectory set on those, and we could see whether we were outpacing those, where we were winning, losing, and why, and what to do about it.
Yeah. Yeah. And David, what was the resolution for this company, and how are they doing today?
Yeah, so it's pretty crazy. I actually caught up with them just yesterday, and we closed out April's results, and it was really, it's really exciting for them. They have come leaps and bounds. So initially, the tactics we deployed with them to help get their cash flow under control was enough that they actually didn't need to engage the bank. And there was a decision to work just directly with the ATO and try to pay the debt off quicker than the ATO had mandated them to do it. And so far, they're ahead of that. As at the end of April, really happy to say, their revenues are up about 29%, but their operating cash flow was up 9-fold. So it's up, 800 something percent. Yeah. So, and that's the thing, is if we can, that's why I say that the forecast can be a leadership tool, because in their case, one of the ways we got such a big jump in that cash flow is we went to the sales team and said, hey, new tactic, we're going to try and win business by leveraging price with terms. And we're actually going to have some flexibility with the terms. And sales team, this is what we're trying to do. This is why. broad picture. Here's how we're going to execute it. And here's a range that we've done the mathematics on and said that this is a safe range for you to play. You have discretion to go and execute that as you wish with prospects and that worked great guns. Yeah. So yeah, they're doing really well and they're now looking to, off the back of that, expand once the ATO debt is paid back.
That's amazing. I mean, it's so good to hear that they were able to turn it around from such a dire situation. I think that's incredible.
Yeah, it was pretty scary for them in the beginning.
Yeah, I can imagine. Yeah. And David, you've also told me kind of a different case here, but another client of yours was growing at a pace that really wasn't sustainable for them in a long term. Can you tell us what caused them to grow so quickly?
Yeah, so this is a slightly different one. This is in a trade service business, and the business had been around for 30 something years. The husband and wife team that we're working with had purchased it from pardon me, from the husband's parents, and they had a rough time during COVID, but came out of it still financially very strong. It's really good, solid business and business model, and a great niche in the market. However, it's good and bad. They have won a series of contracts that they know in 6 to 8 months from now will basically double their business, and that scared them. Like, how are we going to handle this? We feel like we're already at capacity, and they felt just out of control. And they wanted to make sure that when this growth hits, the wheels don't come off, that they're actually able to capture that opportunity and reap the rewards of it. So that's where they reached out. And we've engaged with them to help them understand their financials, get control of their financials. You spoke at the beginning about messy financials. What their financial software said versus their bank account was out by about $1 million just on a single bank account, to do with how their accounting file had been transitioned from one software to another, and journals hadn't been done and all sorts of stuff. So what was being shown in their financial software was totally divergent from reality at some levels, but not others as well, which was a bit strange. So we actually needed, before we could forecast anything, we had to engage with their accountants, bring that team together and actually square away the financial figures, get them matching reality, and then forecast off from there. So that's their situation. And then, it's quite exciting for them. What that has allowed them to do now is, with this forecast in place, the first thing is, the owner, he didn't even, this is a multi-million-dollar business. He didn't even have access to his own financials. He's basically running the business off the bank account. Now he actually sees it from multiple levels. What's the profitability? What's the cash flow? What's the return rates? What's financial health metrics, debt service, so on and so forth. So we've got control of that, but we can see it into the future from a forecasting perspective. We can see when, from a timing perspective, we can see when the contracts are changing. It's a great little feature. It's a bit of a shameless plug, but a great little feature within Fathom when you build the forecast in there. You can take that micro forecast, all these contracts, we build them in as micro forecast, and we could shift the timing of them as we're gathering intelligence each and every week and month from the clients. Because sometimes large construction projects, they will think they'll start here, but they'll end up starting at another point in time altogether. So we could change that and gauge the progress. But that timing links back to what decisions need to be made inside the organization to capture and win when it comes to that growth. That they need to employ project managers and contract administrators and get new vehicles and uniforms and tools, and they're changing location and they're buying a new factory, and all these things are going to shift and move. It's quite dynamic, and the forecast gives them that ability to see it in real time, which is pretty crazy. And what that's allowed them to do is actually prioritize their decisions what needs to be done first. Let's execute that, get that done, bring the team together. Like we said, in the survival setting too, communicating that to the broader group, from the guys on site right through to guys in the office and even external advisors like the accountant. And it's also become a tool for them to look internally and identify ways to boost their own performance, to become more productive. We could see in the forecast, for instance, that was built around a certain gross profit margin based on their history. And we shall assume that that's going to stay the same. Okay, fine. Now, they have now gone and used that as a benchmark to assess jobs done over the last 12 to 18 months to understand, hey, okay, if we want a margin overall of X, fine. Now, how did the jobs we've recently completed stack up against that? Was the margin on the job higher or lower than that? Did we win? Did we lose? What's the lesson there? What would we do or not do again? And also, what did we think the margin was going to be? What did we quote it at? Where was it actually at? And how does that compare to the company? So little things like that we can begin to see.
That's amazing.
Yeah.
And how are they doing today?
Yeah, so they're doing really well. They're pumped for the growth. We're waiting for that wave to hit.
Yes.
And as you've got on the screen, sorry, I got a bit ahead of myself there, but like the canaries in the coal mine for them, the things that we're really watching there is that gross profit margin. We're tracking that. Because their financials were a bit of a mess, we're actually comparing that against their historical jobs too, to see where it stacks up, and just as a further validation exercise on that. We're also tracking that links into that, like their business is basically materials, subcontractors' wages as a proportion of income. They're your cost of goods sold. So we'll track those as a way to understand, hey, if the margin on a particular job is above or below where we want it to be, well, if we can understand what the material subcontractor wages bleed on that job is, we can actually begin to understand what caused that job to go off the rails potentially. Another big thing for them is understanding their cash flow cycle. They haven't, because their financials were a mess, they haven't had the best cash flow cycle in the past. There's some very simple things we've been able to do to get that under control. And we want to, now that we've taken that ground, we want to make sure that we hold it so that when the revenue wave does hit, the revenue is almost self-funding. There isn't a working capital requirement in order to execute it. And again, looking at the current ratio in particular to make sure that the financial health of the business is increasing, its ability to service its debts as and when it falls due is just not an issue for them. And that also factors into how much the owners are able to safely take it out of the business. They have some goals for themselves that they want to do. They've found a holiday house and they want to build that, and they've got kids going into school and all sorts of stuff. So they want to increase their distributions coming out of the business. And we're going to use the current ratio to make sure that any distributions that do take are not putting the business in a it doesn't jeopardize the growth in the journey.
Yeah, it sounds like that current ratio is really key for that forecast when you're looking at that long-term goal for the business.
Can be. It depends what you're trying to get done. And it's not always a simple just, sort of 2 to 1 as a starting point. That will vary industry by industry and exactly what the economics of your business are and its capital requirements and what's going on. And even diving deeper into it, the current ratio is short-term assets against short-term liabilities. So, okay, well, short-term assets, you could still have a healthy current ratio, but bad cash flow off the back of really, really high receivables. So understanding exactly what's going on in there. Yeah.
Awesome. Right. I think that's probably most of the time we have today for the actual session. But before we, close out, David, I'd love for you to just give us some recommendations. If you were a CFO getting started with financial modeling, what are the things you would do, or what steps would you take?
Yeah, for sure. Well, 3 things really, like we have up on the screen there, is understanding what the mission is. Are you looking to survive? Are you looking to grow? What's going on? When? Why? That helps you understand what to do about it. then really understanding the KPIs, what you're looking at, why, what matters, who can you speak to, how do you communicate that across various areas of the company so that you can affect change. And then linking in with both of those is how you present it. We see it all the time. We'll be presenting to a business owner, and we may present, if we just went and presented their balance sheet and spoke about their current ratio, for instance, it may make no sense to them at all, even though the underlying data is perfectly fine and it's correct. They cannot see it in a way that makes sense. So they don't have that clarity, that conviction, that confidence to act. So actually taking your forecast and being cognizant of how you present it back to a decision maker, pardon me, up and down the chain, is going to be really helpful in maximizing the impact that you're able to have.
Yeah. And what types of presentations do clients typically respond to?
Well, it depends. That's what you've got to find out from them.
Yeah.
For instance, you may have someone that's colorblind. So you know what? You're not going to use a traffic light system. You may have someone who naturally understands pictures. So you may lean towards graphical representation, or you could be dealing with someone perhaps with more of a science background or mathematically inclined, and that actually would prefer to see the table of data. And that makes perfect sense to them. So it really depends on the audience. Yeah. And that's part of what you've got to find out.
Yeah.
Part of it may even be trial and error. Present both. See, hey, which one makes sense to you?
Yeah.
Which one would you like me to go with? They're both actually telling the same story.
Absolutely.
But yeah, which one's easier for you to understand?
Yeah, it sounds like it's really about finding which one they respond to and which one resonates with them.
Correct. Where does the penny drop and why? And then working with that. And that too is going to be an evolution. That's not something you'll necessarily get right straight away.
Yeah.
You find that out as you go and you try different things and go from there.
Absolutely. That's awesome insight. We do have a little bit of time left just for questions, and there's a few here that are really helpful. So thank you guys. Feel free to keep those coming as well if you have any that are unanswered at the moment. I have a question from Philip. Do you do due diligence?
Due diligence. Prior to a forecast being made, or due diligence as part of an acquisition? I imagine as prior to a forecast being made. The process that we will use with our clients is, we will have an independent bookkeeping company we work with, sort of go to town on their financial records and see what we can find. But then it's also a matter of engaging with their advisors. So RBI is not an accounting firm. We don't claim to be, don't aim to be. So we will work with whoever the compliance experts are on there. But yeah, we will dive into the detail and see what we can find, and try and uncover what's going on there. Yeah. Usually we find fairly harmless things that are in the wrong category. There's been one case where we've found something criminal and had to move on from there. That can happen. We have come across things that aren't so good, and it just depends what you find.
Yeah.
But that's part of it. The thing I see when it comes to due diligence is you want to make sure that you can't build a forecast and end up lying to yourself. You're going to end up in a really, really bad place.
Yeah.
So you need to be telling the truth. And one of the worst things you can do is you accidentally lie to yourself. Because, things in the wrong place. Different classic one we'll see all the time: markup versus margin.
Yeah.
Guys will think they're the same thing, and they ain't.
I could imagine it's hard sometimes to be honest with yourself, especially when you're in a precarious situation.
It's a tough one.
Yeah.
Particularly for businesses we come across that are in that survival mode or trying to do better. It's like, well, we need to understand what got you here to begin with. Because the way forward is not to continue doing what you're doing. You're here for a reason.
Absolutely.
And we need to be upfront about that. And
I like that.
And we need to be truthful.
Yeah, taking an honest look at the past to improve the future.
Yeah.
That's awesome. Philip's actually clarified here. He's also wondering if you do due diligence as part of an acquisition.
Generally not. No, within RBI, we won't work with that. Yeah, usually not part of our remit.
Yeah, there is as well. I'll just quickly note like a list of services on your website as well. So it's just rbi.com.au.
Yeah, rightbraininsights.com.
Yes, perfect. So feel free to check it out. There's a ton of interesting stuff on there as well. And there's even a nice video from David. So yeah, feel free if you want to learn more. I'll also pop up again, just our direct contact details at the end if you guys have direct questions for us too. I also have another question here. This one's from Deborah. We found that a number of our customers have had to increase their inventory levels substantially in order to mitigate the risk of supply chain increases and delays. Yeah, while this shows challenges in short-term operating cash flow, the expected gain will be in later periods. The challenge is the further out we forecast, the less reliable the data. With many institutional financing opportunities are looking for shorter-term models, how do you overcome this? It's a really great question, by the way.
Well, when you're playing that game around the inventory management, the first thing that comes to my mind is you're looking at a Goldilocks formula. You're trying to find not too hot, not too cold. You can't have no inventory, but you can't send all your cash to your inventory and kill the business that way. So you've got to try and find that balance. The funders not want it. So going out too far into the future, yep. So the first thing that comes to my mind is there's a limit on how far you can practically go into the future too. Like usually when we're working with clients, we won't go out more than 1 year is kind of like quite interesting. Years 2 and 3, we generally won't go out beyond 3.
Right.
Years 2 and 3, it's going to get fuzzier the further you go out. So I'd be saying for an exercise like what Deborah is describing here is, okay, how far out do you practically need to go? For instance, if you're ordering some widget, we had this with a chemical company that we were working with, and a technology one as well. But we had to understand, to get to the bottom of this, we had to understand their individual supply chain components and the lead times on those, and where are they coming from? Because in order to produce something, particularly if you're manufacturing, you can't produce something if you don't have all its components. So you need to backtrack on that. Now, when you're planning for your inventory, you can use the lead time to backtrack on that. So if the lead time, for instance, is 90 days, well, then you might be taking a forecast out for, say, a year. So then you've got 4 times on the lead time that you're trying to work out. Now, if we saw the lead times expand off those supply chain contractions, then that's where we might push the forecast out a little bit further. And actually, you could do both of these. And we mentioned it earlier in the presentation, is building in for that margin of error. Okay, cool. Well, you know what? For something like inventory, that it could move violently. Therefore, we're going to plan for a larger than normal margin for error. We're not going to pick something you'd be tracking inventory days, or perhaps the current ratio again. Or, hey, we're not going to let that go below a stressed level. Perhaps the normal current ratio is 2 to 1. You know what? We're going to plan our inventory levels around 3 to 1. Yeah. Something like that. That way, at least you've got the inherent flexibility. The other thing I'd be thinking on it too is having a refresh cycle built into the forecast. So our standard methodology in working with clients is we'll set a forecast every quarter. So end of every quarter, you're working out your compliance, your logical BAS. We'll work the forecast into it, checking on the goals, the direction, has any of that changed? Rework the forecast, and then for the next couple of months, we're tracking actual against the forecast. Actual forecast. Are we winning, losing? What's going on? What do we do about it? Why? that's something you could do with a situation like this, without inventory, is, hey, you might be adjusting your forecast every fortnight as things change and new information comes in, rather than say every quarter.
Absolutely. I like that. Definitely. I think it can help to reforecast and gain more insight. I have another question here. This one's from an anonymous user. What's your preferred approach to forecasting overheads? Zero-based, 2% increase, etc.
Yeah. Okay. Cool. So from an overhead perspective, the fixed expense base of the business, I'd be looking at it first off historically and seeing where that's at, and then you're also splitting it into. You can go right into the detail and looking at certain accounts. So, for instance, something like telephone expenses I would assume would be fairly stable, right? Whether wages or a component of wages are inside overheads, you may have a very different growth rate applied to wages than you would say to your telephone expenses. So you work it based on that account level. I would start with history and then extrapolating that forward. I'd also be looking at potentially, though not always, the overheads as a proportion of revenue. Now, your fixed expenses shouldn't rise in proportion with revenue, but I'd want to look and see if they do.
Yeah.
Specifically because they shouldn't. And if they are, then hey, maybe that's something that needs to be looked at.
Yeah.
And then you want to find a rule that's appropriate.
Yeah.
I think the danger is applying a blanket rule to it and just assuming straight 2% or something like that. It'll depend on the business and what you're looking at. But,
right. So it's quite literally account level.
Yeah. And see, usually the thing with the fixed expenses or the overheads of the business is, to begin with, that's not normally where I'd look to cut back on in order to optimize performance. Usually they are known and fairly under control. And if you start cutting back on them, you're going to lose something. Everything is a trade-off. The classic one is if you cut back on wages, then you're going to lose some sort of production or revenue generating capacity.
Absolutely.
So you need to understand exactly what we're doing, what's going on there before you just sort of jump into it.
Yeah.
Yeah. Don't know if I've answered the question on that one.
I think you did. And
Yeah.
Look, if anything there wasn't clarified for you, please, again, just feel free to reach out to us directly. It sounds like you have a lot of insights to share, David, and I will say our time is quickly coming to a close. So I just want to pop up our direct contact details on the screen. If you have any questions for David on how he's forecasting or any of the financial modeling he does today, please feel welcome to reach out at his email there. If you have any questions about Fathom as a tool, you can also reach out to me as well. I just want to say thank you again, David, for joining us for today's session. I really appreciate you sharing not only your stories, but your insights. And I want to thank all the attendees as well for joining our session, Financial Modeling, Hope for the Best, Plan for the Worst. Now I'm told there are 2 sessions up next. So one is Stories from Finance Leaders, Achieving Hypergrowth and Breaking the Stereotype, How to Create Change as a Financial Controller. We'll see you guys there.